Welcome to the deep dive. Today, we're doing something a bit different. We're not celebrating a big win. We're actually going to dissect an expensive mistake.
That's right. Our mission is to take this pretty painful finance confession and turn it into, hopefully, a really valuable masterclass for you listening.
We're looking at a $50,000 investment that just, poof, completely disappeared.
Yeah, completely vaporized. We're pulling details from an incredibly honest account, originally shared on the Mr.Finance podcast called The Worst Investment, a Finance Confession. It's really a case study in, risk, hype, and maybe a bit of ego.
And we want to go deep on this because, look, hindsight is 20/20, right? It's easy to see the problems after the crash.
Absolutely.
The real goal here, I think, is to embed these lessons so you can spot these fatal flaws before you put your own money on the line. We want you to walk away with a kind of pattern recognition toolkit.
And the core idea, really, is that success often just confirms our biases, doesn't it? Makes us think we're geniuses.
Yeah, the Midas touch feeling.
Exactly. But failure, especially a big, messy failure like this one, it's probably the clearest teacher you can get. It forces you to be honest, strips away the ego.
Okay, so let's get into it. Let's unpack this Neuroflux disaster, starting with the environment back then.
Yeah.
What made this kind of failure even possible? We're talking 2016, right? The peak of that tech hype cycle.
Yeah, 2016. You have to remember the atmosphere. It wasn't just a strong market. It was steeped in this tech optimism.
Disruption everywhere. Unicorns behind every corner.
Exactly. The source material really paints that picture. The finance world was buzzing about disruption, finding the next unicorn. It felt like world-changing companies were just waiting to be discovered.
And that atmosphere, it sort of creates this pressure, doesn't it? This FOMO, this fear of missing out.
Oh, massively. It's a silent enabler. It wasn't just fear of missing returns, it was fear of missing out on the status of being in on the next big thing.
And the investor in this story, they admitted their portfolio was doing great. They felt like they had that Midas touch.
Which is, paradoxically, a huge vulnerability. That high confidence level, it can blind you.
It seems counterintuitive, doesn't it? You'd think success makes you more careful.
Sometimes. But often that feeling of being invincible, it shifts your motivation. You stop being just a careful investor and start seeing yourself as, a visionary talent scout.
Looking for the next big story to tell.
Right. And when you feel like everything you touch turns to gold, you naturally start taking bigger risks. Why wouldn't you? Your judgment feels flawless.
So due diligence kind of goes out the window.
Or at least it gets really sloppy. You
Yeah.
start looking for reasons to invest, to confirm your genius, instead of actively looking for reasons to say no. Your ego is basically making the decisions.
And right into that environment, into that mindset, walks Neuroflux, the perfect pitch for the moment.
Oh, it was irresistible. Absolutely. Neuroflux claimed they were cracking brain-computer interfaces, BCIs.
I mean, the holy grail, basically.
Pretty much. The pitch was spectacular. A wearable device that could literally read your thoughts and turn them into digital commands.
It sounds like something straight out of science fiction.
And that was exactly the appeal. It wasn't just promising, a slightly better mousetrap. It was promising a complete paradigm shift in how humans interact with technology.
So investors weren't just buying shares. They were buying into a narrative, a revolution.
They were buying the story. The chance to say, years later, I was there at the beginning, I backed them when it was just an idea. That emotional pull is incredibly powerful. Way stronger than a spreadsheet.
And the presentation itself, I gather, was top-notch.
Flawless, apparently. Slick pitch deck, charismatic founder. Which brings us to the actual first encounter.
Right, where did this happen? And what was the investment actually based on, like materially?
Okay, so the setting. A big tech conference in Dubai. High energy, high pressure, lots of hype. Perfect incubator for quick decisions.
And the founder.
Described as super charismatic, a real visionary type. Had that slick presentation down pat. Everything was designed to get a fast, emotional yes.
What did Neuroflux actually have at that point, behind the slick deck?
And here's the first giant red flag, just completely missed in the excitement. The confession is brutally clear. They had zero revenue.
Okay, common for early stage. But what about the product?
No viable product. All they had was a prototype, and we'll definitely need to talk more about that prototype later and this, incredibly ambitious vision.
So the $50,000, it was based purely on hype.
Purely. Hype and the founder's charisma. That was it.
Wow. So it really was a status purchase, wasn't it? A bet on a dream, driven by the ego and the environment, not by any cold, hard facts.
They bought the sizzle. The steak wasn't even in the kitchen yet. The whole structure was hollow from the start.
Okay, so now we dig into the really crucial part, the master class, if you will. The source lays out 4 specific, concrete red flags, things that were visible but just ignored.
And these aren't small things. These are fundamental issues. If you're looking at an early stage deal, this list is basically your emergency brake. Any one of these should make you pause. All 4 together should have been an immediate no.
Let's break them down. Number 1, and this one still blows my mind, given the product. The founder had 0 background in neuroscience.
Yeah, I mean, for a company promising to revolutionize brain-computer interfaces, that's not just a gap, it's a canyon. It's almost disqualifying.
Because BCI isn't just software, right? It's deep tech. It's biology engineering.
It's incredibly complex. You need electrical engineering, advanced signal processing, understanding biological interfaces, navigating potential medical regulations. It's heavy stuff.
So if the founder doesn't have that background, it suggests the whole idea is maybe just market-driven, not science-led.
Exactly. They can talk the big vision-reading thoughts, but they can't actually judge if it's technically feasible. They can't tell a small hurdle from a fundamental impossibility.
Which means the company is basically running on hope. Or relying entirely on others who might not have the full picture either.
Right. It almost guarantees the marketing promises will run way ahead of what engineering can actually deliver. Sets up a huge execution gap from day one. You're building this super complex thing on, well, wishful thinking.
Okay, red flag number 2. This one is about the team executing that vision. The CTO was a recent college graduate.
Again, in deep tech, especially hardware, experience isn't optional, it's critical. You need someone who's been through the wars.
Someone who knows how to actually build and scale things, manage suppliers.
Precisely. A seasoned CTO understands supply chains for specialized parts, the nightmare of hardware miniaturization, managing R&D budgets, hitting timelines. They've learned the hard lesson.
A recent grad, however brilliant, just won't have that practical wisdom yet. Does this also hint at maybe deeper issues?
It really does. It suggests maybe they couldn't afford or attract a veteran CTO. Or maybe more cynically, the charismatic founder wanted someone, more easily managed, someone less likely to push back with hard technical truths.
So the person who should be the internal reality check isn't experienced enough to be one.
Right. They end up just nodding along to the grand vision instead of managing the actual technical risk.
Okay, red flag 3. This one feels almost like theater. The physical prototype was just a 3D printed shell with some blinking LEDs.
This is pure stagecraft. It's designed to look like something is happening. Real deep tech prototypes, especially early ones, they're usually ugly, wires everywhere, big racks of equipment, maybe specialized cooling.
Not a sleek little box with flashing lights.
Definitely not. That 3D shell with LEDs is just visual appeasement for non-technical people in a dimly lit room. It creates the illusion of progress.
The blinking lights are key, aren't they? Making it seem like complex processing is going on inside.
Totally. If they had real BCI tech, they'd be talking signal-to-noise ratios, data speeds, algorithms, not just showing off a plastic case. It screams that the focus was on fundraising, not actual R&D.
Smoke and mirrors, basically.
Yeah.
Confirming the core tech was nowhere near ready, if it even existed.
Absolutely. Which leads us to the last one, red flag 4. The advisory board was just a list of LinkedIn connections.
The classic name-dropping validation strategy. We see this all the time.
And it's so often superficial. A real advisory board contributes actual expertise, time, strategic direction. They often have some skin in the game, maybe a bit of equity. They provide accountability.
So how do you check if it's real? How does a listener tell the difference between a real board and just names on a slide?
You got to dig deeper. Ask specific questions. Do these advisors actually hold meaningful equity? Or just a token amount? Do they attend meetings? Can you see minutes showing their input? Are they endorsing the product or just the founder personally?
So find out if they've actually done any vetting themselves.
Exactly. If it's just a name drop based on a coffee meeting, they're just lending social proof to the founder's story. They haven't kicked the tires for you.
Okay, so we have 4 massive flashing red lights, no relevant founder expertise, an inexperienced CTO, a fake prototype, and a superficial advisory board. Yet the $50,000 was handed over.
Which forces us back to the why. Why ignore all that?
Ego.
It has to be. The investor admitted it. They were chasing the story. They wanted the status, the bragging rights of backing the next Elon Musk.
That emotional desire completely overrode the technical warning signs.
When getting credit becomes more important than getting returns, you've stopped thinking strategically. You're investing for your ego.
And as the source says, ego is your worst advisor.
Because the ego wants to say yes. Saying yes feels like joining an exclusive club. Saying no feels like missing out, which the ego hates more than the financial risk. So you become willfully blind to the obvious problems.
All right, so Neuroflux gets the $50,000. They move from the slick pitch deck into the messy world of actually trying to build something. And reality hit hard and fast, didn't it?
Oh yeah. According to the source, just 6 months later, the cracks were already showing. Big ones.
Like what?
Like missing every single milestone they had set. Every one.
In deep tech, hitting milestones isn't just nice to have, right? It's proof you're making progress. It's vital for keeping investors on board.
It's everything. Missing all of them basically confirms the awful truth. That team, with that tech, they just couldn't build it. The core promise was broken.
So the technology failure was happening, but it sounds like that was compounded by just bad management of the money itself.
Absolutely. Total lack of financial discipline. The source talks about an insane burn rate.
And specifically mentioned spending $20,000 a month on what?
On fancy office space and catered lunches.
20 grand a month. For a pre-revenue, pre-product startup on lunch.
It's staggering. It tells you so much about the founder's mindset. That's $240,000 a year, not going into R&D, not hiring actual scientists, but into keeping up appearances.
Maintaining the illusion of success.
Yeah, it shows a complete misunderstanding of their responsibility to the investors. That money should have been runway, stretching out their time to actually try and build something. Instead, they acted like a successful, funded company before they achieved anything.
Which inevitably puts massive pressure on them to raise more money much sooner than planned.
Exactly. Makes them desperate. And that desperation leads directly to the next phase, the pivots, the panic pivots.
Right. When the main mission fails, you start scrambling. Let's trace that downward spiral, because it really shows the loss of direction. They started with the grand vision, brain-computer interfaces.
Huge ambition, moonshot stuff. But, as we established, impossible for them to deliver. Wrong team, no tech, undisciplined spending.
So, reality bites. Pivot number 2. They ditch BCI and jump to meditation apps?
I mean, talk about a hard left turn. From deep tech hardware needing years of R&D, clinical trials maybe, straight into the crowded consumer software market.
It's basically admitting, okay, the science thing is way too hard.
Completely. It's an admission that they couldn't handle the complexity. But a meditation app, that needs totally different skills. User interface design, user retention, cloud infrastructure, they were just grabbing at something, anything that seemed easier.
And presumably they weren't equipped for that either.
Likely not. The source suggests the meditation app also failed to get traction. Poor execution, probably no real market fit, which led to the final, saddest pivot.
Pivot 3. From meditation apps to wearable mood rings.
This is basically throwing in the towel. From reading thoughts to maybe calming thoughts down to just reflecting basic emotions using old tech. Mood rings use things like skin temperature changes. That's technology that's been around for decades. It's cheap.
It's like saying, we wanted to build a spaceship, but here's a bottle rocket instead.
Pretty much. It confirms they had no core strategy left. Just flailing around hoping something might stick before the cash ran out completely.
And that kind of instability, the high burn rate, the desperate pivots, it attracts the wrong kind of attention, doesn't it?
It sure does. The final blow, according to the source, was a lawsuit from a former employee claiming IP theft.
Oof, that's toxic. Signals internal chaos, maybe ethical problems, definitely huge financial risk for any new investor looking at them.
It was the nail in the coffin. Any remaining investors panicked. The charismatic founder did what charismatic founders sometimes do when the dream dies.
Disappeared.
Vanished. Poof! The company officially folded, and for our original investor, the $50,000 was just gone.
Nothing bad.
Zero. No equity. No refund. Not even a thank you email, as the source put it. A complete and total wipeout.
So the $50,000 loss is bad enough. It's a concrete number. But the confession really stresses that the financial hit somehow wasn't the worst part.
Yeah, the real damage was emotional, psychological. It fundamentally changed the investor's relationship with risk, with their own judgment.
Because it wasn't just a calculated risk that went wrong, it felt different.
It felt like they'd been completely fooled, especially because, as we discussed, the investment was tied up with ego and wanting that status. So the failure wasn't just a market outcome, it felt like a personal failing.
The source mentions a real loss of confidence in their own decision-making.
Deeply. I mean, realizing you were charmed into ignoring 4 huge, obvious red flags. That shakes your self-perception to the core, especially if your job involves making sound judgments. You start questioning everything.
And that had real-world consequences, didn't it? It wasn't just feeling bad.
No, it led to paralysis. The investor admitted they completely stopped investing for a whole year.
Wow. A full year out of the market. Think of the opportunity cost of that, on top of the initial loss.
Exactly. Driven by fear and shame, missing out on any potential gains during that time. It just compounds the financial pain.
And you mentioned shame. That feeling of being conned. That must be incredibly hard to deal with.
It is. It's one thing for a calculated bet not to pay off. It's another to feel like you were targeted, like you were a mark. That shame makes it really difficult to talk about, even to yourself.
Which leads to this interesting point about the culture in finance, right? The stigma around failure.
The source touches on this. Admitting a big loss in finance can feel like admitting you're just not good enough. In a field that really worships competence and constant winning.
So people hide their failures, pretend everything's always great.
Often, yeah. Which leads to isolation, makes the psychological hit even worse. It feeds this cycle of shame. If everyone else seems to be winning, admitting you lost makes you feel like an outsider.
But the turning point here, the real insight from the confession, was realizing that hiding it was wrong, that transparency was actually the way forward.
Exactly. Understanding that failure is just human. It happens. And that talking about it openly, honestly, that's actually what builds real trust in the long run.
Because trust is the real currency, isn't it? Especially in finance.
Absolutely. If you only ever share your wins, people might admire you, but they don't necessarily trust you. You seem unrelatable.
So by sharing the Neuroflex story, warts and all, the investor turned something shameful into this, an educational resource.
Right. They shifted the story from, I got duped, to, wow, I learned some incredibly valuable hard lessons. That vulnerability counteracts the very ego that caused the problem initially.
Realizing the mess didn't have to define them, but they absolutely had to learn from it.
And that brings us to the real payoff from this $50,000 disaster, the wisdom. The investor basically came away with 4 rules, non-negotiable rules for investing going forward.
Okay, these are the key takeaways for everyone listening. Let's make them super practical. Lesson 1. Due diligence is mandatory. Obvious? Maybe. But how do you do it when you're facing that charismatic founder, maybe feeling pressured?
Well, the source gives this great practical analogy. Think about buying a used car.
Okay.
You wouldn't buy a used car without getting a mechanic to check it out first.
Definitely not. You'd be worried about getting a lemon.
Exactly. So don't invest potentially thousands in a startup without doing a similar mechanics inspection on the team, the tech, and any actual traction.
Love that. So what's the mechanics inspection for a startup look like? What are the concrete steps?
Think of it as the 3 T's. First, team. Vet the team. Does the leadership actually have the specific expertise needed for this product? BCI needs a neuroscientist. Complex hardware needs supply chain veterans. Check their track record, successes, and failures.
Okay, team. What's that?
Technology. Vet the tech. Is that prototype real, or is it just blinking LEDs? Is the intellectual property defensible? Where is it registered? Make them show you the real technical challenges they're solving, not just the flashy demo.
Team, tech, and the third T.
Traction. Verify traction. This cuts through the hype about future millions. Traction means real users, real engagement, ideally real paying customers, even early on.
So not just projections on a slide.
No. Ask for proof. User surveys, pilot program results, letters of intent, early purchase orders if they apply. If all they have is a dream about future traction, you need hard evidence they're actually moving towards it. Diligence confirms reality.
Okay, that's super helpful. Lesson 2. Substance over sparkle. This tackles that charismatic founder problem head on.
Right. Charisma gets the meeting, gets the initial excitement, but it's execution that builds a real business. The source puts it perfectly. Hype is not a business model.
So you actively have to look past the slick presentation.
You have to. Focus on the substance. Does the company have real, defensible IP? Do the unit economics actually make sense? Or are they just hoping for scale later? Does the team have a history of delivering? Not just talking, but doing.
If the pitch is all vision and very little how, that's a warning sign.
Huge warning sign. Neuroflex was all sparkle, no substance. They couldn't deliver. You need to invest in the people who can handle the boring, difficult execution part, not just the ones who can paint a beautiful picture.
Makes sense. Lesson 3, the ego check. back to the behavioral root cause.
Yeah, this is about watching your own motivations. Why are you really making this investment? Is it because the numbers stack up, or is it because you want to tell people you got in early on the next big thing?
Investing for status, not strategy.
That's the recipe for disaster, as the source called it. If your main driver is how this investment makes you look, or the story you can tell, you are incredibly vulnerable.
So how do you police your own ego? What's the internal question to ask?
Ask yourself this. If this company goes to zero tomorrow, what will sting more? Losing the money or losing the bragging rights? If the answer is losing the bragging rights, your ego is driving and you need to hit the brakes.
That's a tough question, but a good one.
Yeah.
Detach the ego, focus on the data, even if the data leads to a boring no.
Exactly. A boring no is much better than an exciting wipeout.
Okay, final lesson. Lesson 4. Normalize loss and build trust. This feels like the resolution, the way to make peace with the failure.
It is. It's about understanding that transparency has power. When this investor shared their story, they built trust. People respect that honesty. It makes you more relatable, more trustworthy in the long run.
It humanizes finance, which can often feel quite impersonal or ruthless.
Right. And the big synthesis here is that failure really does teach you things that success papers over. The knowledge gained from this neuroflux disaster about ego, diligence, hype, it was painful, but it fundamentally changed the investor's approach for the better.
So in a weird way, that $50,000 loss might have been the most valuable investment they ever made.
You could argue that. They effectively traded 50 grand for humility, discipline, and a much, much better investment process going forward. That's an incredible return on competence, safeguarding potentially much larger sums in the future. It turned them back into a professional. #outro.
So there we have it, the full anatomy of the neuroflux failure. We followed that $50,000 from the giddy heights of 2016 hype right past those glaring red flags.
Yeah, the founder with no science background, the junior CTO, that fake LED prototype, the LinkedIn advisory board.
Straight through the operational chaos, the panic pivots, and into that final total collapse.
And the lessons, hopefully, are crystal clear for you listening. Due diligence isn't optional, it's mandatory.
Substance has to win out over sparkle every single time.
And you absolutely have to check your ego. Investing for status, just don't do it. It's a path to ruin.
Failure, look, it happens. It's part of the game in investing in a business. But the critical thing is making sure that the mess doesn't just stay a mess.
Right, you have to let the lesson sharpen your process going forward. Don't let the loss define you, let it refine you.
And we'd really encourage you, take this conversation, maybe apply it in your own world, talk about losses, talk about lessons learned.
Yeah, normalize that conversation with colleagues, with friends. Those honest talks are what build real trust, resilience, and better thinking for everyone involved. It helped us all avoid the next neuroflux.
Because if this story teaches us anything, it's that sometimes the most expensive lessons, the ones that really force you to look at your own weaknesses, are actually the most valuable in the long run.
Absolutely. So go vet those teams, scrutinize those prototypes, demand substance over sparkle.
And invest with your head.
Not your ego. Until next time.
Self-destruct sequence activated.